Welcome to the Real News Network. I'm Kim Brown in Baltimore. Interest rates will remain unchanged. That coming out of this week's meeting of the Federal Reserve in D.C. The official word from the feds, per their own statement, is that job gains have been, quote, solid, that household spending has been growing strongly, and inflation is running below expectations. But does this mean that the economy is actually doing well, or are we still in a recession dressed up to appear better than what it actually is? Joining us today from New York City is Gerald Epstein. Gerald is the co-director of the Political Economy Research Institute. He's also a professor of economics at the University of Massachusetts at Amherst. Gerald, welcome back.
Thanks a lot, Kim.
Gerald, let's start with the basics and then we can delve a little bit deeper.
Okay.
If the economy is showing these signs of strength, as the Fed has indicated, then why didn't they raise interest rates now? And do you think that they are likely to do so at all this year?
Well, I think Janet Yellen, who's the chair of the Fed, is aware that even though it's been showing strength and the economy has been growing moderately for several years now, that there's still much more room to go. That is that wage growth, though it has gone up a tiny bit more than inflation recently, is still pretty stagnant, pretty flat-lined. And she knows that there's still a number of workers out there who are so discouraged that they haven't joined the labor force. So Janet Yellen is concerned about the level of employment and the growth of wages, but her problem is twofold. First of all, it's always dangerous to raise interest rates around election time. So traditionally the Federal Reserve, though, tries not to do that, move interest rates right around an election. So that's one factor leading them not to do anything. The second factor leading them not to do anything is that keeping inflation under control is one of their main mandates. They have two: maintaining inflation at a low rate, and they have a 2% target, and reaching high employment. And inflation is still below 2%. There's really no signs of inflation going up. So there's no compelling reason from the point of view of the macroeconomy to raise interest rates.
It's funny that you mentioned that the Fed is less likely to raise interest rates or even mess with the interest rate around election time because the Republican nominee for president, Donald Trump, has already accused Chairwoman Yellen of keeping the interest rates unchanged in order to appease the Obama administration. She, of course, has denied this. What are your thoughts?
Well, I don't think she did it for Clinton or Obama, but it is, I think, a tradition, and it's common for Federal Reserves not to raise and certainly change interest rates right before elections. So she is in sort of the tradition of what the Federal Reserve typically does. And it's also typical, especially recently, for politicians to make the Federal Reserve the whipping boy or girl for political reasons. And sometimes there's good reasons for that. But there was something kind of unusual about this meeting. In the recent meetings, it's been unanimous to keep interest rates the same or to mostly do whatever the Federal Reserve has done. But this time, it was quite contentious. There were actually 3 people on the Federal Open Market Committee, the ones who make this decision, who voted to raise interest rates. And this is kind of a challenge to Janet Yellen's leadership in this regard. And it also shows what kind of pressure the Federal Reserve is under, particularly from the banks, and the mutual fund industry, the insurance industry, because with interest rates being so low, it's very difficult for them to eke out much of a profit. And is typically the case when interest rates are very low for a very long period of time. Some sectors, and very powerful and important sectors of the financial industry, push very hard for interest rates to be raised, and they usually get a pretty good hearing at the Federal Reserve, because the Federal Reserve traditionally has done pretty much what the banks have wanted them to do.
Gerald, it seems as if there's not enough agreement between the Federal Reserve and among everyday Americans on how well this economic recovery is going. So let's unpack some of the elements of this, starting with Chairwoman Janet Yellen's comments on labor markets.
We're generally pleased with the progress of the economy, and the decision not to raise rates today and to wait for some further evidence that we're continuing on this course is largely based on the judgment that we're not seeing evidence that the economy is overheating, and that we are seeing evidence that people are being drawn in larger numbers than at least I would have expected into the labor market, and that that's healthy to continue.
So the unemployment rate was under 5% in August, and the caveat to that is more Americans are working part-time jobs, plus the gig economy is one way that some people are surviving and supplementing their income. So is the unemployment rate published monthly by the Bureau of Labor Statistics giving us an accurate figure on the number of Americans who are out of the labor force?
Well, they don't have an accurate number. There are a lot of, they have estimates, and I think it's true that there are still quite a few so-called discouraged workers who are out of the labor force. And it's also the case, as we said earlier at the beginning, that wage growth has been stagnant. Look, I mean, the Federal Reserve has a real dilemma here. On the one hand, and this is particularly the case with Janet Yellen, who I think does want to indicate that their policies have had some effect. Otherwise, nobody will want them to continue these policies. And she thinks that they have had some positive effect on employment, and I think they have. But on the other hand, their policies cannot turn around the long-run decline of our economy. We need much different kinds, much bigger, much more radical policies in terms of public investment to generate jobs, hiking the minimum wage to a living wage, providing much more in the way of a safety net for workers, protecting pensions and other investments. So the list is very, very broad, and it's very, very deep. And the Federal Reserve has really been pretty reluctant to go further down that list. I mean, the Federal Reserve could do more. They could use different tools to invest directly in the economy. There's a group called Fed Up that has proposed that they do this. But Janet Yellen and her committee want to stay pretty close to the broader toolkit that they've developed, and are really afraid, I think, to take much more radical action, which they plausibly could take. But in the end, it really raises questions of the Federal Reserve's legitimacy. Can they take some kind of really radical action without the broader government saying, go ahead and do it? And until the political stalemate that we have is resolved, I'm afraid the Federal Reserve can't do much more. And that means that this kind of stagnation in wages and so forth is going to continue.
Gerald, you raise an excellent point about wage stagnation and how wages have largely remained flat going back 20, 30, even 40 years, depending on who you ask. But new census data out this month says that household income jumped over 5%, which is the largest such gain in decades. But the top 1% of Americans saw an increase of around 7% rise in their income. If most of the economic recovery gains since the Great Recession of 2007, 2008, if most of these gains have gone to the top 1%, does it still count as a recovery if it's not being felt by the majority of Americans?
No, it doesn't. And this has been a very lopsided so-called recovery. Yes, there have been some modest gains for the middle class and some working class people. So the Federal Reserve actions have had some positive effect. But until you really change the structure, change the tax policies so that the wealthy have to pay more of their taxes, so the multinational corporations can't park their earnings overseas and not pay any taxes like Apple and other corporations have been doing, until you have much more aggressive jobs programs to bring about a green transition and many other things, we're not going to have a real recovery. And these kind of modest, very small sorts of gains, which are gains, but aren't enough, are going to be the best we're going to see.
Gerald, what's keeping inflation in check right now? Is it cheap oil prices?
It's several things. First of all, cheap oil prices and other commodity prices are one thing. But they're also partly related to the headwinds in the global economy against economic growth. China's not growing as much, so they're not demanding as much oil and other commodities. Many other developing countries aren't growing so fast. Europe isn't growing hardly at all. So this really dampens the demand for all of these commodities. And with these prices going down, that does keep inflation in check. The other thing is all the forces that are keeping wages in check. That is, imports from China, the union busting that's been going on, the threat of multinational corporations to move abroad. All of these factors plus more are making it very difficult for workers to have their wages go up. So wages are a cost, so that to some extent keeps inflation in check as well. And finally, you have the retail industry that's subject to lots of competition that just keeps squeezing and squeezing and squeezing workers more and more. Until we get a big increase in the minimum wage, until we get policies to put workers back to work at well-paying jobs, we're not going to see real wages go up, and we're also not going to see prices go up very much at all.
And lastly, Gerald, the wealthiest Americans, the top 1% of Americans, are faring very well. And we are experiencing income inequality at probably the largest gap since the Gilded Age. And we have seen so many cyclical economic bubble bursts over, let's say, the past 20 years, with the tech bubble bursting in the late 90s and then the housing bubble bursting in the mid-aughts. Are we at risk of another such economic bubble burst on the horizon anytime soon?
Yes, we're always at that kind of risk. It's hard to see where exactly the bubble would come from. I mean, there are little bubblets going on all over the place that don't seem so broad and so connected up with debt in the financial system that it seems as though we're going to have a kind of bubble burst the way we saw in 2007, 2008, but we might have bubblet bursts coming here and there in the high-tech industry and so forth. What's more likely is this slow burn of stagnation and increases in distress affecting so many people in the United States, except for the wealthy, who will continue to do very well. Not only is income inequality at all-time highs, wealth inequality, how much assets people own, it has grown and grown and grown. I mean, if you look, for example, if the net wealth, that is assets minus liabilities or minus debt, of African Americans in this country, a report recently came out that said, on balance, the median net wealth of African Americans is zero. There's no net wealth. So this system cannot continue to go in this form. It helps to explain a lot of the political disorder that we're seeing, a lot of the political fighting we're seeing, and it's just going to keep going unless we have some fundamental changes in the economy.
Indeed. We've been speaking with Gerald Epstein. Gerald is the co-director of the Political Economy Research Institute. He's also professor of economics at the University of Massachusetts at Amherst. Gerald, as always, we appreciate you joining us here on The Real News.
Thank you very much, Kim.
And thank you for tuning in to The Real News Network.